China's government has reportedly ordered its domestic airlines to stop accepting deliveries of Boeing jets and to halt purchases of aircraft parts from the U.S.
In a move that's sending shockwaves through the global economy, China has officially canceled all its airplane orders with Boeing, one of America's most iconic companies. Instead, China has signed a historic deal to purchase 500 aircraft from France's Airbus. This isn't just a business decision, it's a political message, and the timing couldn't be worse. It comes right as President Trump was seeking peace with China's leader Xi Jinping, aiming for an economic breakthrough. Make no mistake, this is China's response to the trade war initiated by Trump. The tariffs on Chinese goods were designed to bring manufacturing jobs back to the U.S. But instead of backing down, China is showing it can find alternatives, and it just did so on the world stage. For Boeing, this is the biggest blow in its history, and for America, it's a warning sign that China is no longer afraid to cut ties. The impact on Boeing and the U.S. economy. For years, Boeing was one of China's biggest customers. In 2017, China bought a quarter of all the planes Boeing produced. However, after the U.S.-China trade war, coupled with safety issues with the 737 MAX, China significantly reduced its orders. By 2023, Boeing delivered just one plane to China, a massive drop from over 190 planes a few years earlier. This was a devastating blow to Boeing's bottom line, but it seemed like things were turning around until China suddenly announced it would be buying planes from Airbus instead. This move is far more than just a financial loss for Boeing. The company employs over 140,000 Americans across its factories in Washington, South Carolina, and Kansas. Losing the Chinese market means Boeing could lose more than $1 trillion in potential sales. Airbus rides the wave of success. While Boeing struggles, Airbus is riding a wave of optimism. Following the announcement of the massive deal with China, Airbus shares soared, with stock jumping 6% in just 3 days. Investors are reading the writing on the wall. China is not just distancing itself from Boeing, it's embracing its European rival with open arms. Reports suggest the deal could be as large as 500 aircraft, predominantly from the Airbus A320 and A350 families. If this deal goes through, it will represent one of the largest aviation contracts in history and a strategic shift in economic realignment. With over 1,100 Airbus jets already in service with Chinese airlines, Airbus holds a dominant position in the Chinese market, while Boeing lags behind with only around 600 aircraft in service. What this means for U.S. companies. This is a warning shot to every major U.S. company doing business with China. If trade talks fail, their products could be next. U.S. companies like Apple, Tesla, Ford, and GM rely heavily on the Chinese market for production and sales. China could raise taxes, delay approvals, or squeeze demand for American-made products. Leaving China isn't as easy as it sounds. It's too profitable, too central to their supply chains, and simply too big to ignore. But as trade tensions grow, these companies will have to decide whether to risk losing access to the Chinese market or continue navigating the trade war fallout. The struggle to bring jobs back to America. President Trump's promises to bring manufacturing jobs back to the U.S. have been a cornerstone of his administration. However, despite all the rhetoric, the reality is much more complex. The costs of reshoring are staggering. Labor in the U.S. is 6 to 8 times more expensive than in China. Manufacturing in China offers cheaper labor, subsidized industrial inputs like electricity and raw materials, and minimal government oversight. Meanwhile, the U.S. faces higher labor costs, stricter regulations, and high real estate and compliance costs. The idea of bringing jobs back to the U.S. sounds noble, but the costs are simply too high for companies to ignore. Even companies like Apple, who promised to bring manufacturing home, have continued to invest billions in India instead. Why? Because it's cheaper and easier to do business there, and the country offers a stable political environment. The reality is, most of these companies are not reshoring. They're simply shifting their focus to countries with cheaper labor and fewer regulations. Can the U.S. compete? As of 2025, the promise of reshoring is rapidly fading. While the Trump administration continues to tout tariffs and trade policies as solutions to bring jobs back, the truth is that fewer businesses are actually reshoring than before. Corporate profits are at an all-time high, yet companies still prefer to operate overseas due to the lower costs and fewer regulatory hurdles. At the same time, U.S. exports to China are plummeting. In April 2025, U.S. exports to China fell by 21%, and Chinese exports to the U.S. are expected to drop by 77% in the same year. What does this mean? The trade war is no longer just a battle over tariffs. It's a full-scale trade collapse. The future of U.S.-China relations. With China increasingly turning inward and diversifying its market base, U.S. companies are left facing the harsh reality that their reliance on China may no longer be sustainable. China's rising middle class is now the driving force behind its economy, and its appetite for American products is diminishing. Meanwhile, U.S. companies are struggling to keep up in a global market that no longer sees America as the go-to producer.
If you found this video insightful, don't forget to hit that subscribe button. Stay tuned for more updates and content. We've got plenty more coming your way.